Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the 10th and the last part on the series on the financial accounting ratios. Earnings ratio to 3 of 3. Hope you will like, share and subscribe our channel. Earnings ratio 3 of 3. The 5 standard financial accounting ratios: liquidity, profitability, solvency, turnover and earnings ratio. Introduction. Earnings ratios are also known as the market ratio or market value ratio. The market value ratio is a financial ratio that is used to determine the share price of a company's stock. Hence, the investor measures the market is compatible or not in relation to the company's stock and also the pricing and issuing of the stocks in the open market, as these are concerned with the rate of return on investments for shareholders or stakeholders, and with the relationship between return and the value of an investment in company's share. Market value ratios are financial metrics that measure and analyze stock prices and compare market prices with those of competitors and against the facts and figures. These ratios track the financial performance of public companies to understand their position in the market. Through market value ratios, you can determine whether the stocks of a particular company are overvalued, undervalued, or rightly valued. You can also figure out the optimal prices at which the shares should be bought or sold. Other than evaluating the present share price of a public company's stock, these metrics also help existing and potential investors to make financial decisions about investing in shares. Various financial metrics control share prices in the stock market for business owners as well as investors. These metrics are important to track so that they do not lose their money in wrong financial decisions. Earning ratio, the types. The first 5 ratios we have already discussed in our previous videos, and now we will proceed with the balance of the ratios. PEG ratio and EV to EBITDA. PEG ratio, or simply price to earnings to growth ratio, is a stock valuation measure that investors and analysts you can use to get a broad assessment of a company's performance and evaluate investment risk. PEG ratio is a valuation metric used for stocks. PEG builds on the P to E ratio by considering expected earnings growth and not just current earnings. A PEG ratio of under 1.0 can indicate a stock is undervalued and a potential buy. A PEG above 1 can indicate an overvalued stock. The PEG will vary based on earnings growth forecast and time frame being considered. Formula: price per earnings divided by annual EPS growth. EV to EBITDA is a financial ratio that is commonly used to evaluate a company's value and performance. It measures the relationship between a company's enterprise value, that is EV, and its earnings before interest, taxes, depreciation, and amortization, that is EBITDA. Formula: enterprise value divided by EBITDA. Healthy values below 10 are seen as healthy. EV to sales is a financial ratio that measures a company's total value, that is in enterprise value terms, to its total sales revenue. It is further simplified as EV per $1 of sales. In simple terms, EV to sales is a financial ratio that measures how much it would cost to purchase a company's value in terms of its sales. A lower EV to sales multiple indicates that a company is more attractive investment, as it may be relatively undervalued. This measurement is considered more accurate than the related price to sales because EV to sales takes into account a company's debt load. Formula: enterprise value divided by net sales is equal to MC plus D minus CC divided by annual sales, where MC is market capitalization, D is debt, and CC is cash and cash equivalents. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe our channel, Accounts and Finance with FARSK.